All right. Today is Tuesday, September 14th. This is a recap for the stock market activities today. Of course, the major story of the day was the CPI, aka the CPI, and while the consumer price index climbed higher, the degree of the increase was a lot lower than expectations, and therefore this was supposed to be good news for the market. Now, you and I know that the CPI is a flawed formula. It's garbage, it means nothing, and therefore we call it the CPI. And when we go over the details of the CPI in the headlines of the day video later this evening, you will find out that perhaps the transitory element in inflation is the delta impact, which dented airfare prices, certain energy items. But all in all, the degree of inflation remains stunning. If anything, I say this report is bad for the market. And the reason is, even with delta, the CPI climbed higher year over year, and most importantly, month over month. We will talk about the CPI and the hearing with Gary Gensler, the chairman of the SEC, and of course, the main event of the day from Apple, the revelation of California streaming, whatever that is. Of course, it was a bust, evident with the stock reaction. No innovation at all, nothing new at all. We'll go over the details in the headlines of the day video. For now, I'm keeping an eye on certain issues, specifically when it relates to China. For example, today we saw the stocks of casinos, but more specifically Wynn and Las Vegas Sands, crashing 10% apiece. Why? Because we have more crackdown from the Chinese government against casinos this time around in Macau. It doesn't appear that it's ending anytime soon here, and you have to assume that at some point this will be contagious to the market. If the Chinese are willing to crack down on their own companies, and now on US companies based on Macau, or at least the bulk of the revenue comes out of Macau, when will the next shoe drop? What do I mean by that? I mean, when will the Chinese Communist Party start to crack down against Apple, Starbucks, McDonald's, Nike, etc.? It's just a matter of time, and I believe that the market is not calculating this, it's not factoring this in the wall of worry. When we talk about the catalysts that might crash the market, we talk about the psychology and the normal evolution of a cycle. The bubble starts, it has a start, it has a peak, and then it slides down, and it has an end. We talk about inflation as a risk. We talk about taxation as a risk, but seldom when you hear the risk of Chinese authorities cracking down on US-based companies. Which leads me to the other story that I'm watching, which is the imminent collapse of Evergrande over in China. Now, the Chinese authorities say that this will be controlled detonation of the company. I'm not sure about the controlled part, because when, not if, but when this thing blows up, it will be contagious in Asian markets and perhaps all the way to US markets. You're going to wake up in the morning, you see Dow futures down 1,000. What's going on here? We have the collapse of Evergrande over in China. So this is a story that I continue to watch closely. And the last thing I want to present to you before we move on to the markets coverage is this chart right here, which shows the percentage of US equities that are highly sensitive to economic growth versus highly sensitive to liquidity. For example, back in the dot-com bubble, we had over 40% of US equities highly sensitive to liquidity. And these are the dot-com names: no profits, low margins, in certain cases not even revenue, stocks that only move based on the sentiment and the momentum. Likewise, in this market that we have right now, the bubble of 2020-2021, we have about 35% of equities highly sensitive to liquidity. And at some point that's going to peak. And when the liquidity is removed out of the market, what do you think will happen when we have 35 to 40% of all US equities being highly sensitive to liquidity? The answer is we're going to have a massive crash. For example, in the 2000 bubble bust, the dot-com bubble bust, when the crash happened, it was discriminate, and it hurt the names highly sensitive to liquidity more than names highly sensitive to economic growth, and therefore the crash in the Nasdaq was more severe than the S&P 500 and the Dow Jones. Matter of fact, the Dow Jones, it was pretty much a blip on the radar, not a significant crash at all when it comes to the Dow Jones, the Buffett names, for example. Now the challenge is, will we have the same scenario that we had back in the dot-com bubble, where the names highly sensitive to liquidity crashing, while the names highly sensitive to economic growth continue to hold on and perhaps move higher? This will all depend on the prospects of economic growth. And so far, we have an entire economy pretty much hooked up on drugs and steroids out of the Fed. So, unlike the 2000 bubble bust, the economy has less legs to stand on. And therefore, my belief is when the liquidity is pulled out of the market, the pain will be indiscriminate this time around, at least when it happened. The majority of the pain will happen in the highly sensitive names to liquidity. The names highly sensitive to economic growth will also get a hit, but they will recover faster. And therefore, you want to be overweight in the names highly sensitive to the economic growth prospects because the liquidity sooner or later going to have to be tapered. With this kind of inflation coming out of the CPI, the PPI, and we're about to get the Empire State Index tomorrow. We had the Chicago PMI. We have the Philly PMI coming up this week. All of these are pointing out to inflation not being transitory, which means that the liquidity will be pulled out of the market sooner or later. It will happen, and therefore the market is at an inflection point right now in September heading into October. Do we continue to push higher even though we know that the liquidity is about to be pulled out of the market sooner or later? Or do we conduct a different strategy? And if there is a different strategy, where? Where do you hide in this market? Where do you shift the concentration? We still have TINA for now. There is no alternative beside equities, but where do you hide in this market? We're playing all of these games now, pulling out of the software, high multiple, high growth names because you don't want to hide in these. They will crash first. They will be first to crash. But now we're thinking about big tech. What's going on here? We have Apple being shot up. What about Amazon? What about Microsoft? Perhaps Microsoft is the one, and Microsoft is outperforming today, but it's just a matter of time before Microsoft gets shot too, because it is highly overvalued from a historical perspective. So now we're at this stage in the market where we're looking for a place to hide. Perhaps utilities and REITs, maybe. Perhaps healthcare, but we have a problem with healthcare, REITs, and utilities. From a technical perspective, the divergence from 100 days moving average continues to be extremely steep. So again, I present the question for you. Where do you hide in this market? You know there is TINA, so do you continue to find a place to hide within the equities market, or do you move out to cash? From the news we got regarding Fed President Kaplan and Rosengren, we know that these two are moving to cash pretty much. They're selling at the top, and now they're moving to cash. If TINA persists even after the move to cash, the dips will be bought. But if the crash happens hand in hand with reducing the liquidity and the assets purchasing programs, pushing yields higher, then the dips will not be bought, and perhaps we will enter a bear market for a while. But until then, we continue to monitor the market day by day. We have all kind of predictions. September will be good, October will be bad, says Tom Lee, and he has yet another prediction, more immediate one, which I will share with you in the conclusion of this video. But for now, we're moving on to the market's performance today. And here we go. The Dow Industrial Average closing in the red, down 292.06 points, or a decline of 0.84%. The Nasdaq down 67.82 points, or a decline of 0.45%. The S&P 500 down 25.68 points, or a decline of 0.57%. What about the sector's performance today? Down across the board. No metals at all. Pathetic across the board. Healthcare down. Tech down. Financials down. Energy down. Industrials down. Metals down. Everything down. And when we move on to the advanced decline ratio, the NYSE 23% advancing versus 75% declining. The NASDAQ 25% advancing versus 73% declining. Now, we talk all the time, when we get to such suppressed levels in the advanced decline ratio, perhaps these are indicators that we have a short-term bottom and the market tends to rebound at least overnight or in the morning. But so far, we've been seeing the behavior shifting from buy the dip to sell the rip. And today was no exception. The rip in the morning was sold off right away, and the rips will continue to be sold until and unless the sentiment is changed and we're back at buy the dip. Moving on to futures, what's going on here? The rally in natural gas goes on and on and on. And I had to cover my shorts in natural gas because there are many elements here for the rally to continue. Not just the seasonality of the winter season, but the legitimate shortage that we have from the Hurricane Ida and other events plants, not to mention the administration's policy of being unfriendly to fracking, and now we have a legitimate supply shortage in natural gas. On top of that, we have a lot of shorts being squeezed right now. So all in all, I don't want to stand in front of a wave like this due to the technicals playing a pullback. But I'm just trying to explain how the market works for you. Now that I covered my short, watch how natural gas will collapse tomorrow. What about crude? Crude oil prices flat. The WTI and the Brent closing at the flat line. What about softs? What's going on here? The pop in lumber, the rebound in lumber was short-lived, and we're seeing lumber prices going down again. Likewise, losses for OJ futures. Meanwhile, coffee and sugar futures on the flat line. The gainers in softs futures were led by cotton and cocoa. What about metals? Declines for palladium, platinum, and copper. Meanwhile, modest gains for gold and silver. Now, while the US dollar closed pretty much flat, it closed at the highs of the day, and it looks like the dollar is about to pop higher again. And if it does, then any rebound in gold and silver will be short-lived. What about meats? What's going on here? When you look at the CPI, the inflation in meat prices is absolutely stunning. We looked at the PPI. We looked at the CPI. Understand the PPI is leading, the CPI is lagging, and therefore we pay no attention pretty much, at least for me, to the CPI. I look at the PPI. But regardless, the CPI showed a massive increase in meat prices in the month of August. When you read the PPI, the leading indicator, meat prices went even higher, meaning that the CPI report for September will show meat prices rising higher. And therefore, we're seeing live cattle futures gaining today, along with feeder cattle futures. Meanwhile, lean hogs on the flat line. What about grains? What's going on here? A decent day across the board. We have gains for soybean oil, corn, wheat, rough rice, oats, and canola futures. Meanwhile, we have a pullback in soybeans and soybean meal futures. Moving on to the big casino, the options market. What's going on here? The hottest table, per usual, is Apple with about 1.7 million contracts. About 67% of those were calls. And at number 2, Tesla with about 750,000 contracts. About 56.5% of those were calls. We know that there is funny business going on. Lots of games being played here with the souffle stock. They're buying aggressively the 750 calls for whatever reason, initiating a pop on Monday and Tuesday. And from what we know, the pattern so far, pumping on Monday, Tuesday, and then dumping by the end of the week. We'll see if this will be a consistent theme or not. But from the action today, we have massive buying of call options here, specifically these 750 calls with the expiration date of this upcoming Friday, with only 3 days till expiration. But they're buying about $30 million. $30 million plus on the line for Tesla to close above 750 by the end of the week. Who's initiating these trades? What's going on here? And what is the end goal from these pumpers? What do they want? Of course, don't look for answers at the SEC, because if you watch Gary Gensler today, you have no doubt at all that the SEC is a dormant organization in a coma led by a low-energy individual called Gary Gensler, who almost fell asleep during the hearing today. Now, the third hottest table in the casino today is AMC, with about 570,000 contracts. About 69% of those were calls. Moving on to the unusual activities that took place in the options market today, starting with the ticker CMCSA. This is for Comcast. We got the news in the morning from Comcast indicating that the ads revenue is diving down, not just for Comcast, but across the board, even competitors. TV ads are diving down once again. The revenue is diving down once again. And the main question here is, are advertisers moving to another platform, say to YouTube, for example, or are they pulling back spending in general? We have to distinguish between the two, because if ad revenue is being pulled out of the market for a reason due to the lack of demand or slowing down of the economy, then we got a major problem here. But if the ad revenue is migrating from one platform, one medium to another, then this is normal. No indication whatsoever to the economy in general, but perhaps a bad indicator for TV networks, Comcast in particular. And here we have a trade betting for more pain to come in Comcast by buying the $50 puts with the expiration date of November 19th. With expectations that the name will drop an additional 10% or more by then. They paid about 90 cents apiece to enter. this trade. All in all, spending about $3 million. What about the trade for the ticker AFRM, Affirm? A massive short squeeze, but in the last few days we have profit taking, but my expectations are the short squeeze, the covering will continue, and therefore we have a trader here betting for the rebound and the short squeeze to resume by buying the 115 calls, expiration date October 15th, with expectations that the name will rise higher by more than 7% by then. They paid about $7.20 a piece to enter this trade. All in all, spending about $7 million. This is a big one, a high conviction one, and I don't disagree here. This is the new trend, buy now, pay later, and the collaboration with Amazon will at least push the revenue of this company to rise at least 2 to 3 folds. Next, we have the ticker RCL for Royal Caribbean Cruises. They're buying calls here. This is an interesting one, by the way. They're buying the $100 calls with the expiration date of November 19th, with expectations that the name will pop higher by more than 21.5% by then. And they paid about $1.50 a piece to enter this trade. All in all, spending about $1.5 million. Again, the trader has high conviction that perhaps the worst of the Delta variant wave is behind us, and we will resume cruising once again. I'm not sure about that. I think the industry has bigger problems here. It's not the safety issues alone, but the change in sentiment, the change in behavior in general. Perhaps people are getting more used to staying at home and social distancing. And this whole crowding on stadiums and cruises and concerts, perhaps this is still appealing to a certain slice of the population. Yet a lot of consumers are not ready and perhaps will not be ready to resume spending in these crowding events and experiences, including cruises. What about the ticker XRT? This is for the retail ETF. They're buying puts this time around, the 85 puts to be specific, for October 15th, with expectations that the XRT will drop by more than 7% by then. They paid about $1 a piece to enter this trade. All in all, spending about $1 million. Now we have the contrast here. One trade betting for cruises to rise higher, perhaps a more optimistic take regarding the reopening of the economy and the recovery from Delta. And then we have a more pessimist approach, betting that the reopening of the economy and the recovery from Delta will not be the same this time around, and it will impact retail businesses negatively. On top of that, we're getting more news now that the holiday season will be absolutely awful. And the reason is shipping prices are absolutely out of whack. We have shortages of everything from apparel to toys to consumer goods, and the likelihood is we will have a lackluster holiday season because there is no supply, there is nothing to spend on, and therefore perhaps the XRT retail stocks have already peaked. Some of these stocks went parabolic, by the way, some even exceeding the pre-pandemic highs, which is absolutely insane and not justifiable at all. What about the trades for the ticker XOP? We saw one last night, and here we have another one, betting for the oil ETF to rise higher. In this case, they're opening a spread by buying the 89 calls while selling the 92 calls, all for the expiration date of October 15th, with expectations that the XOP will rise higher by more than 5% but not exceeding 9%. This is the ceiling for the profitability in this trade. They spent about $2.10 a piece for the 89 calls. This is the long leg of the trade, and then we have the short leg of the trade, the 92 calls that they sold. They collected about $1.30 a piece in premium. All in all, that reduced the entry cost to about 80 cents a piece, which brings the total for this trade to about $650,000. Lastly, what about the trade for the ticker NXPI? Chips, what's going on here? They're betting for a pullback by buying the 200 puts with the expiration date of September 24th, with the expectations that the name will pull down by more than 5.5% by then, and they paid about $1.40 a piece to enter this trade. All in all, spending about $1 million. Moving on to the heat map analysis. What's going on here? Red day across the board, losses across the board with few exceptions. These exceptions are mainly some of these stocks moving based on options in the high multiple, high growth names. When they pull back, We have retail traders buying calls, and we have short-term rebounds. We're talking about names like Palantir, CrowdStrike, Zscaler, but perhaps the notable exception is Microsoft and the contrast between the performance of Apple and Microsoft. In the beginning of the video, I was discussing where to hide in the market. When you look at the map, where do you hide? Now that you know that perhaps the Fed will taper, inflation is rising higher, and the prospects of economic growth perhaps not so hot so. On top of that, we have the seasonality and the prospects of higher taxes from the Biden administration. Therefore, once again, where do you hide? In typical markets, in times of volatility, market participants hide in the defensive sectors of the market. These are including consumer staples, healthcare, REITs, and utilities. But what if these don't work out? They're only going to work out if the pullback, the correction, the crash, whatever you want to call it, comes hand in hand with a crash in treasury yields. But if the pullback is accompanied with a rise in treasury yields, in the case of tapering, for example, then I don't see any place to hide here besides perhaps financials. So you have two scenarios here. If the market pulls down aggressively so, while yields also collapsing, then you have utilities, REITs, consumer staples, and perhaps the big pharma names to hide in. However, if the pullback, the correction, the crash, whatever it is accompanied by a rise in the 10-year yield, say tapering is already announced or expected, then perhaps you want to hide in financials. Knowing that, you have to look at your portfolio and look at your exposure. Do this practice, do this exercise with me. Look at your portfolio, and sometimes the platform, Fidelity, E-Trade, whatever you use, it will show you already which sectors of the market you're overweight in, which sectors of the market you're underweight in, or perhaps you have no exposure at all. And perhaps you want to have some exposure to the defensive side of the market, the Procter & Gamble, certain utilities, perhaps REITs, and you also want to consider financials in case yields pop higher while the market goes down. Maybe you'll have a hideout in one of the big banks. Moving on to charts, the SPY 30 minutes chart. What's going on here? We have yet another day of sell the rip. This time around, popping above 447. And by the way, I apologize for the numbers. I'm not sure what's going on here. They're showing all numbers. I'm looking at 447. That's the resistance. And then we have 443. That's the support. We have an error here. I don't know what's going on. But 447 is the resistance. 443 is the support. The chart pops higher once again. Above 447. Now you know we are at the sell the rep market. And perhaps we're not going to bottom unless we see a legitimate buy the dip, the return of buy the dip. Perhaps the bottom will happen when we wake up in the morning and we have a massive down day, gap down, perhaps all the way down to 438, and then we see aggressive dip buying. This will be a solid signal that the market has bottomed. For now, we have no signal at all. We have the chart pretty much tagging the support of 443 and closing right there. We don't have a conclusion yet of what will happen next, but looking at the RSI indicator, the MACD indicator, we are at oversold territory from an intraday perspective. What does that mean? A pop is not unlikely right now, specifically when we head to options expiration. But if I am a market bull, my ideal scenario would be a flush down, a massive one, perhaps all the way down to 438 or even below, and then bouncing higher on aggressive volume buying the dip. Now, what happens if we wake up in the morning tomorrow and we see futures popping higher? The assumption is we will see sell the rip once again. But if it doesn't happen and we continue to see a build up on the gains, we're going to watch 447. This will be the resistance. Of course, what the bears want to see is a gap higher in the morning with another sell the rip. Yet another confirmation of the weakness. But if that doesn't happen and the market continues to build up higher, say an oversold rally, options expiration rally, the bears want to look at 447. If the chart is rejected at 447 once again, you have yet another confirmation that the market is weak and doesn't have what it takes to rebound yet. Keyword, yet. Here's a daily chart for the continuous contract on the SPY. We're pretty much at the trend line. The chart pierced the trend line ever so slightly, and I won't panic even if the chart goes down all the way to 4,384.5. But if that line is breached, then we got a problem, a big one. Because if that happens, then the chart will go down all the way to 4,232. And this will be a steep, a massive correction in the market. So if you are a market bulls, better hope and pray that the market will rebound tomorrow from the trend line. The Qs, 30 minutes chart, what's going on here? We have weakness in the momentum indicators, perhaps stopping the MACD and the RSI indicators, both curling down. Yet the candlestick pattern remains positive, remains bullish, even though we have higher than usual volume here on the downside. The assumption is the bulk of the selling is coming from Apple and some of the high multiple, high momentum names. We're not seeing a synchronized sell-off, shall we say, because Microsoft is closing in the green with gains of over 1%. Now, this chart will not crash. It will not go down all the way to 15,000 and perhaps below that until and unless the FANG names are shot. Not one of them, not two of them. All of them have to be shot. We know Apple has problems now. The event was a bust, and on top of that, we have a ruling cutting their racketeering operation, the shakedown business, the highest margin business in Apple. Do we have problems with Google, for example? Yes, we do. If Apple is shot, then the assumption is the regulatory strike will hit Google next. Likewise, today in the morning, we got the story against Facebook. According to Facebook's internal data, its own data, they're finding out that Instagram is harmful to young adults and children, specifically young girls. What kind of a role model do you see on Instagram? A bunch of women doing soft porn, flaunting their fake asses, their photoshopped asses all over Instagram. And this, of course, causes body confidence issues for young girls. We're hearing a lot of bad stories, a lot of sad stories here regarding depression and suicide among the youth due to body confidence issues. And you bet that this story will blow up. This is a bombshell, by the way. It's just a matter of time before Facebook is shot next. So that leaves Microsoft the only man standing here. But in my opinion, Microsoft will not be able to stand alone here. It's just a matter of time before Microsoft is shot too. You're going to see revenues declining. You're going to see subscriptions declining. The Azure business growth declining. Xbox declining. Something declining. And this will be the leading catalyst for Microsoft to drop. Now, I am an investor in Microsoft, and I choose Microsoft because all of the antitrust, all of the regulatory actions are already behind us when it comes to Microsoft. But when it comes to Google, Apple, and Facebook, this is new territory. And therefore, in my decision of picking Microsoft as the only big cap technology stock in my portfolio, this was part of the calculation. This was part of the analysis. What is the regulatory risk when it comes to Microsoft versus Apple, for example? And now we know the answer. Moving on to the IWM 30 minutes chart, what's going on here in the Russell 2000? We talked about casinos down, but we have a lot of travel names also down. Likewise, meme stocks were down today, specifically AMC, and therefore we have weakness here in the IWM. Now, I'm highlighting the RSI indicator, the intraday oversold conditions. Every time we're trading here, we see bounces. Now, understand that this is not a buy or sell signal. This is just an indicator that perhaps the chart is oversold from an intraday basis, and this has to be resolved by at least an intraday pop. That could be gapping higher, it could be trading higher for a little while, and then the sell-off resumes anyways. So you're not going to make buy and sell decisions based on the RSI indicator, from an intraday perspective at least, which leaves us looking at 218 for support and 223 for resistance. For now, the chart is pretty much trading between the lines. I'm not buying the dip here at all. Until and unless 218 holds for support and we see a bounce, a sizable one with higher volume, then I will be playing a bounce in the IWM. What about the Dixie? What's going on here? Again, trading pretty much flat, but all in all, at the highs of the day, when you look at the MACD, the RSI, the lackluster reaction to the CPI, you and I know the US dollar is about to pop higher. And the ultimate confirmation will be closing the day above 93. Now, when the dollar trades higher, is this good or bad for stocks? The answer is mostly bad. And the reason is the higher US dollar will push commodities down. Pushing commodities down will push pretty much the entire inflationary sector of the market down, which includes metals, industrials, energy, etc. All of these sectors of the market will trade down. What about gold? What's going on here? Gold bouncing higher today, but again, I'm not reading a lot into it here. Gold has two enemies. The dollar was down in the morning. Yields were down big today. Perhaps a reaction to the CPI, and this is helping gold to rise higher a little bit. But again, the action in the US dollar, and I trust the dollar as my leading indicator, by the way, regarding tapering. The action in the US dollar closing at the highs of the day says that if anything, the CPI report that we got in the morning today is bad for the market, indicating that even with Delta, inflation continues to rise higher year over year and month over month. So we know that the dollar will pop higher. We know that yields for now, we're talking about the 10-year, has a solid floor. And this floor is 1.28%. So long as 1.28% holds, the assumption is yields will move higher. And when they do, this will be bad, ultimate nightmare scenario for gold. And here is the chart of the 10-year yield. As you can see, 1.28 is holding for now, but we're seeing some weakness from the MACD indicator. Again, if yields drop below 1.28, then perhaps gold will have a catalyst to continue to move higher, even if the US dollar moves slightly higher. But if both of them move higher, then bye-bye gold. What about the TLT weekly chart? Bond prices, what's going on here? Popping higher, closing above 149, at least for now. We have 3 days left in the week. Anything could happen. But when you look at the MACD indicator, look at the RSI indicator, the momentum has a lot of room to go here. In an explosive scenario for the TLT, it has plenty of room to go all the way to 170 if it wants to. But understand this. If the TLT pops all the way to 170, it will come hand in hand with a crash in yields, perhaps all the way down below 1%. What will be the catalyst for such scenario? It will be an ultimate collapse of the economy, something really bad and even worse than Delta. VIX, what's going on here? Look at the MACD indicator from a 4 hours perspective. It looks like, I repeat, looks like the pop is over in the VIX. And if that is the case, then the VIX has met the resistance of 20 and it's unable to close above 20. Likewise, the SPY is pretty much at the trend line, which merits a bounce. If I'm reading the charts correctly here, the VIX topping, the SPY at the trend line of support, shall we say VIX down, SPY popping higher, and we'll take it from there. Apple, what's going on here? We have yet another rejection from 150. So we have a confirmation that 150 is a no-go here. We have a soft support at around 147. The likelihood is this will not hold. So again, we have conflicting messages here. The VIX showing signs of topping. The SPY showing signs of perhaps bottoming, at least for now, seeking a bounce from the trend line. And then we have Apple, which is pretty much the highest weighting in the market, showing a lot of weakness here. What about Tesla? What's going on here? We have higher highs and higher lows. And this pattern has been broken. Now we have lower highs and lower lows, yet the pumping remains relentless via call options. Folks, they're buying the 750 with the expiration date of Friday, meaning they're looking for a pop. They're not going to hold all the way to Friday, unless they know something that we don't know. But if they don't, then they will start closing these trades, perhaps starting tomorrow, and we will see the chart pulling down. 720 is the line in the sand, breaking that level, closing below that level, we will see a lot of pain in the souffle. What about BTC, tulips? What's going on here? We still have a bear flag regardless of the pop, perhaps on the heels of comments from Mama Cathie Wood, aka Tesla Witch Cathie Wood. Tesla Witch Cathie Wood came in the morning and said that Bitcoin will increase tenfolds, meaning it will be at around $500,000 a piece with a valuation of about $10 trillion. And you know what, folks? At some point, we gotta stop listening to Cathie Wood. She's overrated. She had the hottest hand on Wall Street, not due to her expertise or magic or perhaps interventions from the Holy Spirit. She had the hottest hand because she invested like a Robin Hood, like a teenager. And this strategy was beautiful in the era of printing on steroids. So long as the Fed is printing out of thin air, flooding the market with liquidity, the wood stocks, the hot stocks, high multiple, high growth, and no earnings, the market was supportive to these kind of investments. Remember the highly sensitive to the liquidity. This is the era of Cathie Wood. But if this era is about to end, then we will see the end of Cathie Wood. And by the way, the market has a sigh of relief here, the crypto market that is, the tulip market, because Chairman Gary Gensler was not aggressive as expected in his commentary regarding cryptos. So perhaps we have a sigh of relief here that Gary Gensler will not crash Bitcoin, at least not anytime soon. But I continue to watch the tulip market in general because if the market is about to crash, we're talking about the equities market here. You need the sentiment to be shot. And so long as cryptos and meme stocks continue to rise higher, forget about a crash in the market because the sentiment remains intact. But the moment the equities market starts to sell off, along with cryptos, along with memes, then we got a problem, which leads me to AMC, the meme of the memes. AMC down big today, about 8%, perhaps topping at the resistance of 52. And we're seeing weakness right now in the MACD indicator and the RSI curling down, perhaps creating red impressions on the histogram of the MACD, which means a loss of momentum. And if that is the case, then this is the top at AMC, and we will see more pain to come in the next few days. When we look at the weekly chart, it's even more alarming because we have a pullback. Yes, we have 3 days left here. Anything could happen. But if AMC closes like this, way below 52, look at where the MACD indicator is trading at from a weekly perspective. Either we're going to have a crossing creating green impressions in the histogram, indicating that the momentum has recovered and we have more juice to squeeze here. But if the momentum indicator starts to curl down, failing to cross, oh boy, this is one of the most bearish signals in the market. And if it happens, bye-bye AMC, bye-bye memes, and it will be ugly because the sentiment is shaking off the market. You're not going to see just AMC and GME going down. It's going to be everything going down together. Lastly, moving on to conclude this video, what do we have on the economic calendar tomorrow? We have the import price index, but most importantly, we have the Empire State Index. I will be watching this one closely because Delta has pretty much a minimal impact in the New York area. So if prices continue to climb higher in the Empire State Index, then rest assured inflation did not go anywhere and it will resume increasing once again in the PPI and the CPI. Lastly, I have a request for you. Please stretch your arms with an open palm because Tom Lee would like to read your fortune because we have fortune teller and market astrologer Tom Lee.
And there's a strange seasonal underway, which is this sell Rosh Hashanah by Yom Kippur, and that's actually on Thursday.
Yeah.
And I think because data's so daily, it's actually a bigger role this year.
And Tom Lee says, this is his latest prediction, by the way, he says the market will sell in Rosh Hashanah, but it will bounce back in Yom Kippur, the Jewish holiday, which happens to be tomorrow. So if Neptune is right and Tom Lee is right, we're supposed to have a bounce tomorrow on Yom Kippur. Now remember, it might happen, but you gotta take whatever Tom Lee says with a grain of salt. Yes, the young generation, the naive young generation that invaded the market last year, don't know the truth about Tom Lee, but we do. And Tom Lee pretty much follows the obvious. The statistics say every year, the probabilities say that we have a Santa rally. So Tom Lee comes out in October, November and says, we're about to have a Santa rally. And when the obvious happens, the Santa rally, everybody says, wow, Tom Lee is a genius. And now we have a predictable pattern of selling in Rosh Hashanah and buying the dip on Yom Kippur. And again, there are statistics and probabilities supporting the pattern. So Tom Lee is telling the obvious here. But remember, when we needed Tom Lee the most, in 2008, the man totally blew it. He said that the S&P 500 will reach all-time highs by the end of the year. And we all know what happened in 2008, 2009. But again, I thought you'd like some fortune telling here from Tom Lee. And with that, ladies and gentlemen, I'm done here. This is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.